How's it going, everyone? Matt Leighton. Welcome back to another real estate video. In this video, we're going to be going through the biggest credit mistakes that first-time home buyers are making when they're purchasing their first property. So if you're thinking about buying a house and maybe you had some credit questions or maybe some credit issues that you weren't quite sure how to proceed, then this is the video for you. We're going to dive into the top 5 mistakes first-time home buyers are making when it comes to their credit. So let's start with mistake number 1. Mistake number 1 is opening a new line of credit. Just because you're under contract and you're closing in 30 days doesn't mean you can go ahead and open a bunch of new accounts. What will end up happening is your lender's going to be pulling your credit a couple days before closing to confirm that it's about what it was when you first got pre-qualified and started the mortgage process. And if you've gone out and bought a bunch of new furniture items, right? You've gone out and leased a car or financed a car or bought a boat or something crazy like this. Well, simply you're just not going to be approved and you may be rejected for that loan you were looking to get. So bottom line, have the same number of accounts from when you started the process to when you close. Just because you're under contract and you're closing quickly doesn't mean you can go ahead and start opening up some new accounts and getting the travel bonuses and whatnot. Get those after you close. Mistake number 2 is having too high of a balance on your credit card. Now, most people know not to max out their credit card, not to spend every last cent that's offered to them. But I want to take this to the next level because there's a lot of information out there that says you should spend up to 30% of your entire credit line. But I say cut that in half and only try to spend up to about 15% of your credit. So if your credit line's around $5,000, that means only spending about $750. So your utilization ratio is around 15%. And if you do spend more than $750, what you can do is ask for a credit line increase. So maybe that $5,000 gets bumped up to $7,500 or even $10,000. The second tip I have is to actually pay off your card before your statement hits. So let's say you did a one-time purchase of $2,500 and your credit line is $5,000. Well, now your utilization is 50%, which is not good at all. But if you did have that cash on hand, don't wait until your statement is ready, because once it gets to your statement and your statement is posted, that means your credit card company sends that information to FICO, and now all of a sudden FICO sees that your utilization ratio is through the roof at 50%, and that may decrease your score. Instead, if you have the cash on hand, pay off your card before your statement actually hits. So bottom line, guys, try to keep your ratios under 15%. And if you are making large purchases, be sure to pay off the card before the statement actually hits. The third mistake is paying off debt. And this one's gonna sound kind of backwards to start, but let's envision a scenario where you have some money saved up for your down payment, but you'll also have accumulated some debt, not a lot, maybe a couple $1,000s. Does it make sense to pay off the debt first? Or does it make sense to go get a mortgage first? Now, certainly, I'm not advocating for not paying off the debt and then bringing on more mortgage debt, but I want you to understand that if you are using your cash to pay off other debts, then that's gonna decrease your purchasing power because you're gonna have less money on hand for the down payment. Now, everyone's scenario is different. So let's say you had $2,000 of debt and $10,000 of cash that you're gonna put towards your down payment. Should you pay all of the $2,000? Should you just pay $1,000? Should you not pay anything and then go get a mortgage? Well, it's gonna all depend on your certain scenario, right? It's not a blanket answer. My recommendation is to work with a local lender that fully understands your financial picture, that can lay out like 2 or 3 solid options for you, and then you go ahead and choose the best option for you, because your real estate agent and your lender should be providing you with options, real estate agent for houses, lender for paying off debt and credit issues, and then of course, you as the consumer should be making the final decision. It should never be up to the lender to tell you what they might say. Hey, you're only pre-approved for this, but ultimately it's you, the consumer, that's making the final decision. So if you do have debt, before you start paying it off, or if you're in the process of paying off debt, be sure you're talking with a local lender to fully understand all your options so you're completely comfortable moving forward. The fourth mistake is closing out old accounts. And this happened to me recently as I was looking at my LL Bean card, which I no longer use. I was thinking about closing it out. And this was the card I got when I first got a credit card. It's my first credit card ever. I got amazing deals on flannel, but I've now come to realize just how bad of a card it is. There's just much better options out there. So I was thinking, you know what? I'm just gonna close it out. Nothing's happening. I think I just put one reoccurring charge on it. But while I was looking deeper into it, you know, I got this card before I got any other cards, like a few years before. And if I were to close it out, that would significantly affect my credit score, because one of the factors for credit is how long that credit account has been established, basically the age of the credit account. So because I got LL Bean deals on flannel so many years ago, it really helped out with my credit score. And if I were to close that out, then my average score would decrease significantly, and then that may affect, you know, imagine if I was under contract and I was like, you know what, I don't use this card anymore, I'm just gonna close it out. Well, now all of a sudden my credit scores decreased 20 points and I'm no longer eligible for the loan program that I was looking at. So if you have an old account like an LL Bean card or something like that, don't close it out, because that's gonna negatively impact your credit score. If you're thinking about cleaning up your credit cards and whatnot and organizing it, maybe just keep it active and throw on one charge like I do every single month so it stays active. You don't want to close out the old accounts, because that's going to negatively impact your score. And the fifth mistake is not getting a free credit report. You, by law, are able to get a free credit report once a year, basically every 12 months. And the advantage of this is you get to see line by line item of every single account that you've ever had. By not getting a free credit report, you're running the risk of not fully being aware of what's keeping your score so low. If your score is a little bit lower than you'd like, or if you're wondering how to get it a little bit higher, go get your free credit report to fully understand all the line items. Because maybe, you know, a phone bill slipped through the crack, or maybe you moved and a company sent a bill to the wrong address and now that bill's in collection. The free credit report is an amazing tool to fully understand your entire credit history so you can hopefully increase your credit score. Basically, it comes down to you don't know what you don't know. A free credit report is, I literally don't know how else to describe it. It's free and it is a report on your credit, and I highly recommend you get one every 12 months. Okay guys, there you have it, the top 5 mistakes that first-time homebuyers are making when it comes to their credit and buying property. If you like this video, be sure to hit the thumbs up button, and if you're not already subscribed, what are you doing? Go ahead and hit that subscribe button, and I'll see you in the next video. Okay guys, until next time, create a productive day. Take care.